Incyte Q2 2026 total revenue hit $1.67 billion, which is up 38% year over year. Total net sales reached $1.49 billion, representing a 40% jump.
Huge numbers.
Yeah, non-GAAP diluted earnings per share came in at 3.09, nearly doubling the 1.57 from the same quarter last year. And based on that momentum, management just raised their full year 2026 net sales guidance to a range of $5.13 billion to $5.26 billion.
But, for you listening, we really need to strip away the noise from those massive headline numbers. We've pulled together Incyte's Q2 earnings report, their recent clinical trial data, and management's forward-looking guidance to give you a clean, concise breakdown of what is actually happening under the hood.
Because it's a lot to digest.
It is. We're going to isolate the one-time accounting events to find the true organic growth. We'll dissect the structural improvements to their profit margins and, unpack exactly where their aggressive multi-billion-dollar R&D investments are going.
Right. So let's start right at the center of that 40% net sales growth because, when you see a top-line number jump that dramatically for a mature biotech company, you immediately have to ask, what is acting as the lever?
Exactly.
For Incyte this quarter, that lever is Opzelura. They reported Opzelura net sales of $450 million for the quarter, which looks on paper like a 173% increase year over year. But as a financial analyst looking at this, I see a giant accounting asterisk attached to that specific figure.
Yeah, it is a $246 million asterisk, to be exact.
Wow.
And to understand why that money suddenly appeared, you have to look at the mechanics of pharmaceutical rebates, specifically with the Centers for Medicare and Medicaid Services, or CMS. For a long time, the government and Incyte have been locked in a dispute over Medicaid rebate rules.
And this centers around something called a line extension regulation, right?
Right.
Walk us through how that actually works, because I know it trips up a lot of retail investors.
Sure. So a line extension rule is basically a regulatory guardrail. Historically, some pharma companies would try to extend the profitable life of a drug by making a tiny tweak to it, like turning a tablet into a capsule.
Just to keep the patent alive.
Right, and calling it a new drug to avoid paying higher rebates back to the government. CMS created rules to penalize that. The dispute here was whether Opzelura, which is a topical cream for skin conditions, should be legally classified as a line extension of Jakafi.
Which is Incyte's oral cancer pill.
Exactly.
I see where CMS was coming from since both drugs utilize the exact same active ingredient, ruxolitinib. But treating blood cancer with a pill and treating a skin rash with a cream, those feel like two completely different universes.
Which is exactly what Incyte argued. But until the dispute was settled, conservative accounting practices dictated that Incyte had to hold back massive amounts of cash on their balance sheet.
Ah, I see.
Yeah, just in case they lost and owed those punitive rebates.
Yeah.
Well, in Q2, CMS finally agreed Opzelura is not a line extension.
Okay, so that frees up the cash.
Exactly. Because of that ruling, Incyte was cleared to reverse all those previously established accrual balances dating back to March. That accounting reversal triggered a one-time non-cash benefit of $246 million that dropped straight onto the top line for this quarter.
I have to challenge the actual quality of this earnings beat then, because if I'm holding Incyte stock, I'm looking at this and thinking, okay, they just found $250 million in the regulatory couch cushions.
Right.
If we strip out that one-time legal windfall, what does the real demand for Opzelura actually look like? Is the core business actually growing, or is this quarter just a mirage?
No, it's the right question to ask, but the underlying organic demand holds up incredibly well to scrutiny. When you back out that $226 million one-time benefit, Opzelura's actual net sales for the quarter were $204 million.
Okay.
That represents a 24% organic growth rate year over year.
Okay, 24% true volume growth is highly respectable for a drug already doing hundreds of millions in sales. Where is that patient demand actually coming from?
Total prescriptions grew 26%. And that's driven by patient uptake in both of its approved areas. So that's atopic dermatitis, or AD, and vitiligo.
Got it.
But the CMS settlement does something much more important than just providing a one-time cash injection. It fundamentally and permanently improves Opzelura's gross-to-net profile on a go-forward basis.
Okay, so gross to net, or GTN, is essentially the difference between the sticker price of the drug and the actual cash the company gets to keep after paying out all those mandatory rebates, distributor fees, and discounts.
All right, exactly.
It's like buying a car. I mean, the sticker price is one thing, but the dealer incentives and taxes dictate what actually leaves your wallet.
That's a perfect way to look at it.
Yeah.
Because Incyte no longer has to accrue cash for that heavy line extension rebate rate. Their GTN profile immediately tightens up. They keep more of every dollar they sell.
Makes sense.
In Q2 alone, that structural improvement added about $15 million to real net sales. And moving forward into Q3 and Q4 this year, Incyte estimates this improved gross to net will add an extra $40 million to $50 million to their net sales.
So it's a dual-engine growth story for Opzelura right now. You have the 24% organic volume growth of more patients getting prescriptions, paired with a structurally more profitable revenue stream per script.
Exactly.
That definitely explains why management confidently raised their full-year Opzelura guidance all the way up to a new midpoint of $1.07 billion.
Yeah, the regulatory overhang that was depressing their margins is just gone, and the organic adoption is accelerating. It's a very clean narrative.
Okay, so Opzelura's cash flow is highly secure now. But to understand how Incyte is actually operating, we have to look at the foundational drug that built the company and funds everything else. We really need to transition over to Jakafi.
Jakafi is the anchor, period.
Yeah.
For Q2, Jakafi pulled in $817 million in net sales, which is a 7% increase year over year, and that growth is healthy. It was driven by a 9% increase in paid patient demand.
Just to ground this for anyone new to the biotech space, Jakafi is a JK inhibitor primarily prescribed for myeloproliferative neoplasms, which are essentially rare blood cancers. We are talking about polycythemia vera, myelofibrosis, and graft versus host disease.
Right.
These are conditions where the bone marrow overproduces blood cells, making the blood thick and sluggish. And Jakafi works by blocking the specific signaling pathway that causes that overproduction.
And it is deeply entrenched as the standard of care for those conditions.
Yeah.
But if you're analyzing this stock, the most critical thing to monitor with Jakafi right now isn't the core pill. It is the recent launch of Jakafi XR, which is their new extended release formulation.
Right.
In Q2, Jakafi XR generated just $10 million in net sales.
Which, I mean, $10 million feels like a rounding error in the context of an $817 million quarter. Why is that specific product launch so important?
Because it is entirely about patent life cycles and defensive modes.
Right.
The original Jakafi is an immediate release pill, meaning patients often have to take it multiple times a day. An extended release, or XR version, allows for once daily dosing. That dramatically improves the quality of life and compliance for the patient.
Right, nobody wants to take pills all day.
Exactly. But strategically for Incyte, migrating their patient base over to a newly patented XR formulation helps protect their overall market share as the original immediate release pill eventually approaches its loss of exclusivity and, faces generic competition down the road.
I always look at Jakafi like a highly mature, massive cash cow business that is effectively funding an internal startup incubator. Jakafi throws off nearly $1 billion every 3 months, and management takes that cash to build out the rest of the portfolio.
Spot on.
But for years, the primary concern around Incyte was concentration risk. If Jakafi ever faltered, the whole company would sink. So the critical question for retail investors looking at Q2 is the startup incubator actually yielding results? Are they diversifying away from Jakafi?
The segment data strongly suggests the diversification strategy is working. Incyte refers to their non-Jakafi oncology drugs as their hematology and oncology portfolio. This is their dedicated growth engine.
Okay.
In Q2, this segment hit $222 million, which is a massive 69% increase compared to last year.
Wow, 69% segment growth for oncology assets is serious momentum. What are the specific drugs pulling that weight?
Well, you have 3 main pillars. Niktimvo, which treats chronic graft versus host disease, brought in $60 million, up 67%. Then the Monjuvi and Minjuvi franchise, which targets specific lymphomas, generated $54 million, up 72%.
Right, but the real outlier in the data is Zynyz. They reported Zynyz printed $50 million this quarter. That is a 460% jump year over year. Why is a single drug scaling that rapidly?
So Zynyz is a PD-1 inhibitor approved for some very aggressive skin cancers, specifically Merkel cell carcinoma and squamous cell carcinoma of the anal canal. A 460% jump usually indicates rapid market penetration following a recent approval or, a major shift in clinical guidelines where doctors suddenly adopt it as a preferred first-line treatment.
Makes sense.
When you take this surging hem-onc portfolio and combine it with Opzelura, You get what Incyte classifies as their core business. It's their label for everything that isn't Jakafi.
And that core business reached $671 million for the quarter.
Yes, that's up 44% year over year if you strip out the Opzelura CMS cash. If we zoom out, management has a stated goal to reach $3 billion to $4 billion in net sales for this core business by 2030.
That's a huge target.
It is, but hitting a $671 million run rate in a single quarter in 2026 proves they are fundamentally on trajectory to hit that target. They're successfully shaking off the Jakafi-only label.
So the top-line revenue is growing, and they are successfully diversifying the portfolio. I mean, that is a textbook bullish setup. But we have to travel down the income statement now. Strong revenue only matters if the cost to generate that revenue leaves room for profit.
Yeah.
Let's talk about margins and operating expenses.
Yeah, this is an area where Incyte's profile is incredibly unique. Look at their cost of goods sold, or COGS. It came in at just $105 million for the entire quarter.
Just to put that in perspective for you listening, they generated $1.49 billion in net sales, and it only cost them $105 million to physically produce the drugs.
Exactly. That means their COGS represents a mere 7% of total net sales.
That's wild.
Those are gross margins you typically only see in cloud computing software, not physical manufacturing. Because their flagship products are small molecules and highly scalable topical creams, rather than incredibly complex biologics, they are able to throw off a massive amount of gross profit.
But here is where we hit a massive expense spike that anyone holding this stock needs to understand. While their factory production costs are lean, their operating expenses are about to explode. Management drastically raised their GAAP R&D and SG&A guidance.
Right, SG&A being selling, general, and administrative expenses, the cost of running the corporate side and the sales teams.
Right. They are now projecting their total operating expenses to land between $4.91 billion and $4.99 billion for the full year. That is a jarring hike from their previous guidance. Where is all that cash suddenly going?
It comes down to a massive capital allocation decision.
Yeah.
Incyte just acquired Vega Therapeutics. They paid $1.25 billion upfront in cash, with the potential for another $750 million in future milestone payments if certain sales targets are met.
Let's unpack the accounting mechanics of this first, because I know it trips up a lot of people when they read biotech earnings reports. Why does buying another company cause your research and development expenses to spike so aggressively? Why don't they just put the $1.25 billion on the balance sheet as an asset?
Under GAAP, which is generally accepted accounting principles, you can't always capitalize an unapproved experimental drug the same way you would capitalize, say, buying a new factory or a piece of equipment. Because a drug in clinical trials might fail and eventually be worth zero, conservative accounting requires companies to take an in-process research and development charge, or IPR&D. It forces them to expense the cost immediately.
Oh, wow.
So in Q3, Incyte will record a massive $1.27 billion IPR&D expense to account for the Vega upfront payment and transaction costs. Additionally, they are adding $50 million to their guidance just to cover the ongoing R&D costs of running Vega's clinical trials.
So if you are an investor, you need to brace yourself. Q3 earnings will look heavily depressed or even negative on a strict GAAP basis because they have to digest that $1.27 billion charge all at once.
Depressed on paper, absolutely. But strategically, this is exactly what you want a cash-rich biotech company doing. It's real capital going out the door today to buy future revenue streams for tomorrow.
Which brings us to the core strategic question. Management looked at the entire biotech landscape and decided Vega Therapeutics was worth $1.25 billion. What specific asset did they want that badly?
They bought Vega for a single, highly promising asset called Latarcibart. It is a phase 3 monoclonal antibody being developed to treat von Willebrand disease, or VWD.
And von Willebrand disease is an inherited bleeding disorder. It means your blood lacks a specific protein needed to clot properly, leading to severe, sometimes life-threatening bleeding episodes.
It is actually the most common bleeding disorder globally. But the current standard of care is brutal for patients. It often involves frequent intravenous infusions, requiring patients to sit in clinics for hours.
That sounds awful.
It is. Latarcibart is a paradigm shift. It operates as a novel protein S modulator.
Meaning it interacts with protein S, which is a natural anticoagulant in the body. So if you have VWD, your blood already struggles to clot. So if this drug modulates protein S, it is essentially putting the brakes on the body's natural anti-clotting system to help the blood coagulate.
Exactly. But the real game changer is how it's delivered. It is administered subcutaneously, so just a simple injection just under the skin. and it only has to be taken once a month.
Wow, going from regular 5E infusions at a clinic to a once-a-month jab you can potentially do at home is a massive quality of life upgrade. But does the efficacy hold up?
The phase 1 and 2 data they presented recently was incredibly compelling. They demonstrated an 81% median reduction in the annualized bleeding rate across all categories of the disease.
An 81% reduction in bleeding events is a massive efficacy signal. Now, the $1.25 billion price tag makes a lot more sense.
No.
It also fits their broader corporate strategy perfectly, because Incyte already dominates the malignant hematology space, the blood cancers, with Jakafi. Buying latarcibart allows them to take their existing commercial infrastructure, their sales force, their relationships with hematologists, and pivot into non-malignant hematology.
Right.
They are opening up an entirely new, massive addressable market without having to build a new sales ecosystem from scratch.
It's a textbook natural adjacency.
But this brings up a critical point about timelines for retail investors. Incyte is pouring billions into external acquisitions like Vega, but we know latarcibart won't even have phase 3 data until early 2029. So what is going to move the needle for the stock in the near term? What does the pipeline watch list look like for the back half of 2026?
CEO Bill Murray specifically addressed this timeline gap on the call. He highlighted that they're expecting 10 clinical data readouts in the second half of 2026 alone, and crucially, 4 of those are from registrational trials, meaning the data is designed to be submitted directly to regulators for drug approval.
Let's break those near-term catalysts down. I'm looking at their regulatory timeline, and the European expansion for Opzelura jumps out at me immediately. But the report mentions a positive CHMP opinion. Walk us through what that actually means for their launch timeline.
The CHMP is the Committee for Medicinal Products for Human Use. It is essentially the European equivalent of an FDA advisory committee. Getting a positive opinion from them almost guarantees formal approval. Incyte expects full European approval and launch for Opzelura in moderate atopic dermatitis in Q3 of 2026. This officially opens up a massive new geographic market for their fastest-growing asset.
And what is the second major regulatory milestone?
Povorcitinib. This is their oral JAK1 inhibitor. The FDA has accepted their application to use it for moderate to severe hidradenitis suppurativa, or HS. They anticipate an EU launch in late 2026, followed by a US launch in Q1 of 2027.
If you aren't familiar with hidradenitis suppurativa, it is a chronic, severely painful inflammatory skin condition. It causes deep nodules and abscesses, often in sensitive areas of the body. It is notoriously difficult to treat, and the impact on a patient's daily life is devastating.
Yeah, it's terrible.
The unmet medical need in the HS market is massive.
Which is why Incyte is trying to blanket the entire HS market from multiple angles. Povorcitinib is their oral systemic treatment for the severe cases. But for patients with mild to moderate HS, they are running phase 3 trials using their topical ruxolitinib cream, the exact same cream used for Opzelura.
Think of the inflammation in HS like a fire breaking out deep under the skin. The topical cream is like spraying water on the surface for the mild cases, but povorcitinib, the oral systemic drug, is like installing an internal sprinkler system to put out the severe fires at the source.
It's a great analogy. And we are expecting the phase 3 top-line data for that topical cream in mild to moderate HS in Q4 of 2026. If the data is positive, they could effectively corner the entire spectrum of the disease.
Brilliant franchise management. Now, beyond hematology and dermatology, I have to ask about their solid tumor pipeline. Incyte has always been a blood cancer and skin company, but they are making a very aggressive, very expensive push into solid tumors. Tell me I'm not crazy for thinking this is a massive risk.
It is a risk, definitely. But the proving ground for whether it pays off will be the ESMO Congress, the European Society for Medical Oncology, in October 2026. Incyte is slated to present data across their late-stage solid tumor portfolio.
This includes their CDK2 inhibitor for ovarian cancer and their KRAS G12D inhibitor for pancreatic and colorectal cancers.
Right.
But the one that stands out to me is their TGF-beta R2 by PD-1 program. That is a bispecific antibody, right?
Yes. A bispecific antibody is engineered to bind to 2 different targets simultaneously. Think of it like a molecular two-handed grabber.
Okay.
With one hand, it grabs onto a specific receptor on the tumor cell, and with the other hand, it grabs onto a T cell from the patient's immune system, physically dragging the immune system right to the cancer's doorstep to attack it.
That's incredible.
ESMO 2026 will be the moment the broader market gets a clear picture of whether these complex solid tumor assets can legitimately challenge the established pharmaceutical giants.
So when you step back and look at this entire Q2 report, Incyte is standing at a fascinating inflection point. For the last decade, they have been defined almost entirely by the success of Jakafi. But right now, they are aggressively deploying their massive cash pile, which sits at 4.5 billion as of the end of June.
Yeah.
They drop 1.25 billion on Vega to enter bleeding disorders. They are funding AI discovery partnerships with Edison Scientific and Genesis Molecular AI to accelerate how fast they can design new molecules. The ultimate question for you as a retail investor to mull over is this. Can Incyte's management successfully integrate these massive external acquisitions, run a dozen late-stage clinical trials, and execute a highly complex solid tumor pivot, all before the Jakafi cash cow eventually begins to slow down?
If you want to stay ahead of the curve and track how management executes on those catalysts, make sure you follow the show for our daily earnings coverage. See you on the next one.